Welcome to Personal Finance Cat, where I share my personal take on personal finance.
Today, we're diving into the fascinating world of value investing. We'll discuss the 5 most common myths about it and explore why it works. Yes, it still does work, and it's the only one that has withstood the test of time. Before we jump in, I wanted to share my journey of discovering value investing. If you're a skeptic, you want to keep listening because it may resonate with you. I just recently learned that I'm a very intuitive person, and probably you are too if you're entrepreneurial and generally willing to try new things. Maybe that's why you're watching or listening to this. Sometimes, though, I rely too much on intuition and lack the patience to investigate and research things. That's why it was a long journey before I discovered value investing. For the longest time, I thought, if investing is a learned skill, everybody would be doing it. But why is there only one Warren Buffett? I also have heard too often that, quote, you cannot control the stock market, end quote. Quote, most people lose money in the stock market, end quote. Quote, more than 90% of professional fund managers do not outperform the S&P 500 index fund, end quote. So for well over a decade, I resisted investing in stocks and thought that it was just for suckers who didn't see the obvious. Instead, I did real estate investing and some other things. It worked out okay, but man, was it a lot of work and stress. And boy, was I not positioned competitively at all. I didn't know how to hold a paintbrush, couldn't tell the difference between a boiler and a furnace, had no idea how much it would cost to repair anything, and so on and so forth. I still don't, and that's what I meant by me not knowing anything about real estate investing. Thank goodness for the forgiving real estate market, and truthfully, inflation. It worked out okay, but it really sucked. Then why was I drawn to real estate investing in the first place? Because there are so many sponsored social media ads nowadays about real estate investing. They made it sound so easy, and who doesn't like easy money? After almost 10 years of investing in real estate, I thought I was doing great, until I realized that I wasn't. Yes, I had accumulated 2 dozens or so rental units, but it's not life-changing money or sufficient cash flows for me to retire on. I knew I needed to do something else, and I always know that a W-2 is not going to cut it for me. That's when I started looking up Warren Buffett. Why Warren Buffett instead of anybody else? Remember that I said I was intuitive? Intuitively, I knew I needed to learn from the very best, not some random dude or dudette who claimed some sort of shortcuts. That's very simple logic to me. Also, shall I say it's a hard lesson learned from real estate investing? There are a lot of salesy people out there who try to tell you that there is another way, or they have the magic formula, or how much money they have already been making, etc., etc. Just pay them X amount of dollars, and they will teach you everything they know. Sorry, I've had too much of that. Nowadays, I can smell scan like a shark can smell blood. Anyway, once I started down this path, I soon learned this phrase of value investing, and I learned that only value investing has withstood the test of time. There are other methods of investing, for example, momentum investing, which is basically like trading in my mind. Okay, I have to put it out there. I don't think the whole concept of trading makes sense at all. There's nothing magic about these charts. Just by looking at the charts and the candlesticks isn't going to tell you squat about anything. I struggled to find any trader that consistently made money. And believe me, I Googled hard. I know it's tempting because some of these traders look like they're making a lot of money, and in a very short amount of time, sometimes literally within a day. But again, I don't get it on a fundamental basis, so I don't even bother. Someone once told me that Bill Ackman is a trader and he's a billionaire. So I researched him, and guess what? Ackman can't stop talking about Warren Buffett. So no, Bill Ackman is not a trader. He may have done some epic trades, but the principle of his investing style is, again, value investing. So what is value investing, you ask? At its core, value investing is about buying stocks that appear to be undervalued by the market. It's like shopping for quality products on sale. You're looking for a good deal, companies that are priced lower than their intrinsic value. Why does it work? The magic lies in the fact that it's simple. If you find a company that you know a great deal about, and this is what Warren Buffett calls being in your, quote, circle of competence, and the price is clearly below its intrinsic value by a large margin after your research confirms it, Then you invest in it, and the rest is just a waiting game. Wait a minute, that sounds too good to be true. Right, that's why I wanted to clarify the 5 common myths about value investing. Number 1, value investing is too hard.
Defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
You may say, I have no idea what you were talking about when you explained what value investing is. What is intrinsic value? And how do you know that the price will eventually reach its intrinsic value as opposed to staying low forever? Great questions. Intrinsic value is what the stock should be worth based on the future cash flows. If a company generates a lot of cash, and there's a high level of certainty that this company will continue to grow and continue to generate cash flow every year, then you can discount those cash flows to today's dollar value, which is a pretty standard financial model called the discounted cash flow model. There are a ton of videos out there to teach you how to do this kind of modeling. About the second question, why would the price not always stay low? To answer this question, I have to introduce Benjamin Graham, the founding father of value investing and Warren Buffett's teacher. Graham very famously analogized the aggregate behavior of all the participants in the stock market as Mr. Market, who is this crazy person with unpredictable mood swings on a daily basis. But in the long term, he gets the price right. Here's a quote from his groundbreaking book, Security Analysis. Quote, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. End quote. So, simply put, there could be stupidity in the market during the short term, but the bubble always bursts eventually, and vice versa, and people came back to reality. Think about the tulip bubble, the South Sea bubble, and the dot-com bubble, and the list goes on. So, value investing isn't hard, but it does require patience. When Mr. Market goes out of his mind one day and puts a value stock on sale, that is when a value investor strikes. Number 2, value investing doesn't work. After all, there's only one Warren Buffett, and maybe he just got lucky. If it really works, how come not more people are doing this? Well, you are not the first person or the only person who thought of this. As a matter of fact, there is an academic theory about why somebody like Warren Buffett shouldn't exist. And this theory is called the efficient market theory, or EMT. The EMT states that the market is so efficient, whenever the stock price deviates from the intrinsic value, some people from the large pool of market participants will swoop in and close the gap instantaneously. So, in theory, a person like Warren Buffett, who consistently wins in the marketplace, is an anomaly. And it happened probably just because he got lucky. Well, what was Warren's reaction to this? Basically, this is his reaction, which is shared by many value investors. The EMT is BS, because value investing created tremendous wealth, not only for Warren Buffett, but a big concentration of well-to-do value investors in Omaha, Nebraska, where Buffett is based, and those elsewhere who are willing to learn from him. As to why not more people are doing this, listen to Warren Buffett himself explaining to you in one of his most iconic interviews, way before he became a world-renowned investor and before he became a billionaire.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics you mean professors of
right,
finance?
The data's there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data.
Surprisingly or unsurprisingly, his advice hasn't changed much since then. Number 3, value investing is boring.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers.
I remember hearing a famous influencer in the business category touting her skills in investing in boring businesses and called her portfolio a baby Berkshire. I can see why people think value investing is boring, but that conclusion can't be more wrong. Yes, Warren Buffett may hold the stocks of those old school companies like Coca-Cola, Geico, and American Express. That's not because by being boring, those companies make you money. The key of determining whether a company is worth investing in is, besides the historical consistency of growing cash flows, whether the company has a competitive, durable advantage that can withstand the test of time. In other words, you know, not feel or guess, that there is a high certainty that the company is going to continue to grow and generate handsome cash flows. That's why it's critical for you to know the company, the industry in which it operates, the competitors, and everything else about the company very, very well. Again, this is what Warren Buffett refers to as sticking to your circle of competence. He has ultra in-depth expertise level knowledge in insurance, banking, and consumer products. And the companies he invested in were squarely in those circles of competence. But you don't have to invest in those companies if you think they're boring. If you think gaming is exciting, for example, and you know a lot about gaming, did you study NVIDIA? Social media? How about Facebook? Cars? Check out my episodes about Tesla. That's right, value investors have invested in those companies and made whopping returns. That influencer, well, the businesses that she bought, like laundromats, may be truly boring because they have no competitive advantage whatsoever. The economic profit is truly zero for those businesses, meaning after you pay for all expenses, including an extrapolated salary for your own time, there's no profit left. So think super carefully before you go ahead and buy the really boring businesses. Otherwise, learn how to value invest in great businesses, not the boring ones. Number 4, if you're a value investor, you would never have invested in high growth companies like Amazon. This is literally what a friend of mine once told me. Oh well, he's wrong. A well-known value investor, Bill Miller, is best known for his investment in Amazon, especially when the company's stock price was at the deep bottom during the dot-com bubble burst. Miller became one of Amazon's largest shareholders through his Legg Mason Value Trust Fund. At its peak, Miller's fund was one of the largest institutional holders of Amazon stock. Miller's bold stance on Amazon is often cited as one of the key factors that helped his fund outperform the S&P 500 for 15 consecutive years from 1991 to 2005. Of course, he was critiqued for investing in Amazon and calling himself a value investor, to which he responded, "I saw plenty of value there." So a little bit more background. Amazon wasn't making a profit back then, let alone consistent profit. However, that is because it kept putting the profit it did make back into R&D in order to develop new technologies that can help it continuously and speedily grow into the truly customer-centric e-commerce platform that Bezos always envisioned. That was the foundation for it to become the dominant player in e-commerce that it is now. No wonder even Warren Buffett admitted that he was stupid not having invested in Amazon early on.
Defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value. But there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
Berkshire does have a small holding of Amazon nowadays, but by one of his investment managers, Todd Combs or Ted Wishler. Number 5, I just have to follow what other value investors are buying. By now, you may be semi-convinced that value investing does work. And you're thinking, why don't I just go out and buy the same exact stocks that Warren Buffett or Berkshire Hathaway owns? Or better yet, just buy the Berkshire Hathaway stocks. Well, not so fast. You heard me mention the word discount a couple of times already. Yes, you have to buy the stock at a deep discount in order for value investing to work. You may have heard that Berkshire Hathaway outperformed the market by a long shot when you look at a long time horizon, say 50 years. But in the last 10 to 20 years or so, the S&P 500 index has performed better than Berkshire. Has Warren lost his touch? That's debatable. There are many reasons for this. For one, the stocks that Berkshire can buy are hugely limited to only large cap stocks, which tend less likely to be mispriced. But my point is that there is no guarantee if you buy Berkshire Hathaway now at the current price, it's going to give you a good return, ideally better than the S&P 500. You really have to do the research and be sure that there is deep value there. And everybody is different. Your circle of competence may be wildly different from Buffett's or any other famous value investors. Again, it's not hard to do the research, although I have to clarify. It's not hard in the sense that you can learn what to do and how to do it, but there is indeed a hard part.
You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think.
And that is, you need to have the temperament to know you're right, not just because other people say you're right, but because your research, logic, and thinking make you right. Alright friends, that is a wrap on my take of the 5 most common myths of value investing. I've learned so much in the last couple of years since I started researching, and I'm really excited to share these thoughts with you. Hopefully you find them helpful. As to my own value investing results, so far I've slightly outperformed the S&P 500 index, even with some big mistakes in there. But hey, as Bonish Pabrai, a big Warren Buffett fan and an even bigger Charlie Munger fan, said many times, even the best investors are wrong 1/3 of the time. I don't feel too shabby. The best part, this side hustle of investing does not come with a boss, any employees, or any customers. What better alternative can I ask for? Anyway, thanks so much for listening. Bye for now.